Hi, good morning, and welcome to our quarterly market update with our team from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. Good morning, guys.
Good morning.
All right, so as we're populating the room this morning, we're going to start off with a quick poll just to check and see where you might be feeling least comfortable right now. It's been a choppy first quarter in the financial markets. We just want to take the pulse of the room so we make sure we address some of the primary concerns of any number of things we could be talking about this morning. So take a minute and we'll tabulate the poll results and then we'll kick off. All right, awesome. We'll close out the poll and show you the results here. Looks like by a pretty wide margin, the least level of comfort is in stock market exposure, which makes sense. It's we've had one of the choppiest first quarters in a long time. And I think we're going to talk through some of the implications of that for financial planning and how we prepare for the rest of the year to come. Great. So retirement preparedness second, level of savings third, and spending level fourth. Excellent. All right. Well, we see a lot of familiar faces here this morning and some people joining us here for the first time. By way of introduction, Morton Brown Family Wealth is a firm founded 4 years ago today with the idea that we are family conversations about money are unique. Every family has a unique relationship with money. Our team, we are all certified financial planners. So we're going to talk about investing and planning today. We're conversant on topics related to taxation, retirement, insurance, estate planning, all of those things. To the extent you have questions, we invite you to weigh in today. The chat is live throughout the whole conversation. If you want to toss a question up in the course of one of our presentation points, happy to answer it. We're also going to leave some time for Q&A. We really feel this is a benefit for the community that we're building. If one of you has a question, there might be a dozen other people wondering the same thing. So as we can all share and learn from each other, that's a great benefit. Katie, I'll turn it over to you.
Yeah, we're really committed to holding these interactive events. It's a way for us to share what we're thinking, what we're learning, and around investing and planning for the clients and the families that we serve. There's always a lot of ground to cover, and we have a lot to cover here in this next half hour. But I think especially during these times of turbulence, it's really important to open up that dialogue to talk about what we're observing and to help provide some context around that. This is about you guys too, and thank you for completing that poll. As Dennis said, if you have questions, please feel free to populate those. We really want this to be valuable for you in your time. As we think about the markets, thinking about like right now, we're recognizing kind of the stark difference between investing in a crisis and investing coming out of a crisis. Sometimes this investing in a crisis, things are moving so fast that it's kind of all we can do to hold on and endure the turbulence. Whereas when we think about the investing piece coming out of the pandemic, we're starting to recognize, how that's impacted markets and maybe how new trends might be forming and how that influences our assumptions going forward. And we're all trying to figure it out. But one question that may be kind of common across many of you listening today that you might have in the back of your mind is, are we okay? And so as we go through, a review of what's happened the first quarter, we're going to help build some of that context and hopefully address that question a little bit. But please know that we always welcome the opportunity to speak more specifically to really help to address that question for you and your family. So why don't we dive in here into the slides?
All right, Cody, you want to take it from here?
So as Katie was saying, we've had a lot of volatility over the first quarter. And so today, the first couple slides will go over what happened in the first quarter. And we will go over what happened in April too, because we obviously don't want to skip over April, as April's been brought a lot of volatility too. So some of the positive signals we're seeing coming out of the first quarter is various stats are telling us that people are trying to get back to where we were pre-pandemic. So if you look at the travel rates, going to restaurants, hotel bookings, those are all getting pretty close to where we're actually some of them back positive for where we were before the pandemic. So that's obviously a positive signal, which is in the economic indicators that we'll look at in a couple slides down. Most of them are still stable and they're improving going forward, which is a good sign too. Unemployment fell to 3.6% in March, which is one of the lowest levels in a long, long time. So that's a great thing. And obviously, I'm sure a lot of us see when we go to restaurants or just out day to day, people are still trying to hire. So that's a positive signal moving forward. And then one positive signal that has came from maybe one of the negative things in the first quarter is with the drop in the fixed income principal, we're actually able to get a better income yield from some of the fixed income going forward. So that's one of the positive signals coming out of the first quarter too. And some of the concerns or just reasons for concerns looking forward is inflation is obviously a lot higher than the 2% target that the Fed has for the inflation number. Rising rates can be painful for investors when it's happening, which I'm sure we've all felt over the first quarter and second half of 2021. So that's something that we have our eye on. And then one of the major concerns, again, along the rising rates is, will the Fed get it right? Will they be able to slow down inflation without stalling out the economy? And I think that's one of the major concerns going forward too.
Yeah, I think this is, sometimes we even compare this to, if we're looking for a positive or a silver lining in the first quarter, it's that a lot of these negative catalysts are landing on an economy that's pretty strong. Similar to what happened in the pandemic. Coming out of 2019, the economy was in a pretty good place, low unemployment. Things were chugging along nicely, and that helps kind of buffer us against some of the worst outcomes that can happen if there was structural weakness.
Yeah. This slide that we brought forward from Nuveen, which is one of the major asset managers inside the US, is just showing how even their expectations are all over the place. So they have a small 10% weighting on a potential recession, 50%. So their major projection is a soft landing. The Fed will get to a neutral rate. Earnings will still be positive going forward, and hopefully assets outperform going forward. And then their other small is stagflation, where inflation remains high and growth potentially declines. But then you can see their second major prediction of 30% is just unknowns. So somewhere completely outside of these three, just that right now there is a lot of uncertainty in the market and on the fixed income side too, not just stocks.
Yeah. I really appreciate this because I think it's fair to say nobody actually knows how this is going to play out. But it's good to build that awareness and to kind of, check in at where you're at and your own risk levels, but recognize that nobody can predict it exactly. And I think we're hearing that from more and more, financial institutions and economists out there, that all of these things could happen, but we don't know exactly what. And so it's important not to stamp down that bet.
Yeah. I mean, again, coming back to the last recession, at the end of 2019, you had kind of whispers of an inverted yield curve or some other signs that, oh my gosh, there's a recession coming. And then it came from a pandemic out of left field, like something that in November of 19 we could never have predicted. By 2020 was a reality. So there's that 30% uncertainty that you never know where it's going to come.
Yeah, I think it's looking back to this, at least speaking for myself, I think going into 2020, coming out of 2019, everything seemed like it was going well. But you can see on this chart, which goes over the economic measures, red is a slowdown, green is very good, yellow is slowing down towards the red. You can see in 2019, we're actually going from a very strong green number slowing down a little bit. Obviously, the red came from the pandemic, but then we've bounced back pretty fast. And then going back to one of the positive signals, we still have a good and stable improving economy going forward too, but that this chart shows.
Yeah, really the only places showing weakness are in emerging markets and Russia, which makes sense considering all that's going on.
Yeah. So one of the slides that we wanted to make sure we cover, as it's always a headline, is inflation, especially with the large numbers we've seen in 2021 and especially in the first quarter of 2022, with inflation getting close to 8%. This breaks it down in different sectors, with the green being energy, which is making up most of the inflation numbers that we've seen recently. Red is being used in new car vehicles. So you can see back in 2021, that was such a small portion of the inflation number. But now with the supply chain issues, we've seen that jump up, where that makes up over 1% of the inflation numbers we've seen recently. And then you can see the other ones come from food, has gone up a little bit, but that hasn't jumped too much. Hopefully supply chains will ease there and that will come down a little bit. And then some of the other and shelter and restaurants. So everything has seen a little bit of a jump up, but the energy and used cars has had the most jump over the past year in the inflation numbers.
Yeah. And just to kind of fill in that bucket there on the other, a lot of that, it's like medical supplies, home furnishings, just, a variety of different kind of smaller components in there that could potentially be sticky. I think that's what's interesting about this chart too, is that it shows, it kind of breaks up between the things that may be, that our inflation will be set on kind of going forward versus the things that could potentially be transitory. And we're starting to see that slow down a little bit on these inflationary numbers. Things that have been kind of jumping out of control are starting to kind of like slow down a little bit. So once again, we don't know exactly what's going to happen with inflation, but I'd say overall consensus is that we're not staying at these levels. It will come back down likely to something a little bit more normalized by way of history, maybe not normalized by way of recent history. So, we'll see where we land, but it'll probably be higher than we have had in the past decade. Expect that it will be, but probably won't run away as at the same pace that it has been.
I think it's also from a planning perspective, which of these are you exposed to the most? So for somebody who's not in the market for a new or used vehicle, that changes the equation for you. For a retiree or someone who owns a house, for example, and isn't renting and isn't exposed to higher rental prices, higher housing prices, or maybe owns the asset of a house, the equation is different. So I think that's where it comes to a very personal conversation of where are your exposures to inflation and how do you manage that?
Mm-hmm.
Good point. And with some of the higher inflation numbers, the Fed wants to get control of that. So what they've been doing and what they started doing in the first quarter is raising interest rates. And as we can see, that has taken a hit on the fixed income return. So some of the stable assets that most people have inside their portfolio, fixed income, has actually had one of the worst first quarters just because we've gone from pretty much a zero Fed interest rate environment, and they're slowly, at least their game plan is to increase the interest rate. So we've seen a hit to the actual principal of fixed income. And as we can see, quarter one, which is the year to date in this graphic, everything is negative for the year on the fixed income space.
Yeah, and I think one of the things that the decision that you've had to make over recent years is, when you have bonds, if you have a 60-40 stock and bond portfolio, of that 40% that are in bonds, what type of bonds do you want to own? If you stay shorter term and higher quality, that's when you're landing in kind of the more preservation side here. The longer term you get out, the higher the volatility is. So this doesn't even show long-term bonds. This chart does. So you see the shorter term and intermediate term kind of navigating, the 2, 3, 7% down range. Look at the performance of long-term bonds. They're acting like stocks. So one of the ways to increase your income in recent years is to buy longer-term bonds, but this is where you pay the price for taking on that risk. So the navigation of fixed income investing and what you do on the conservative side of your portfolio really matters at times like this.
Yep.
Really quickly, do you want to hop back to the last slide and just because people might ask, what is this 4%? What actually performed there in the fixed income world? So this is looking out over 12 months, and this bar here are from Treasury inflation protected securities. So those are inflationary linked bonds that are designed to kind of keep pace with inflation. So those have been kind of the one area of the fixed income market that has held value. The pace that it's held value has not been quite as strong just recently. A lot of their return, I think, is already kind of baked in there, but there's still value in sort of those shorter term tips, as we call them. So I just didn't want to ignore that little upswing in there.
Yeah, and that's an important point because there are very few things that keep pace with inflation in real time. And even tips are imperfect because you can see, they're negative so far this year. Inflation is not negative this year. So, there's imperfect. Cody, let's skip forward to the stock side because that's when we talk about keeping pace with inflation. One of the best ways to do it is to make money before it gets there. So You can see on the right here. Tell us what we're looking at on this chart.
Yeah, so this is the U.S. Stock market and their returns first quarter, and then over the last 12 months. And then just to point out, these numbers are down even a little more than what this graphic just shows, because this is the end of March, where in April we've had a little continued sell-off. But the black is large cap growth. So this is some of the companies that had the strongest returns over the last 10 years, such as Apple, Google, Microsoft, some of the tech plays. And then we've actually seen a little bit of outperformance. It's still negative, but from the value side, so far year to date, which is some of the more energy or utility plays or financials, have done a little better so far year to date, just with some of the expectations for potentially growth slowing down for some of these companies. Which, if we jump forward to this chart, this goes over so far year to date. It includes April. So we can see the sell-off that we've had from April has been pretty steep, especially in the large cap growth space and the small cap growth, with both of them off 20% year to date.
Mm-hmm. Mm-hmm. Yeah, and I think one of the things to mention, and Cody, I think we have this on the next slide, the energy exposure here within sectors. We're going to flip over to the next. Oh, actually, no, I don't think I'll put that in. So this period right now is one of the widest dispersions between different sector performance. So whether you look at energy or utilities or technology, consumer discretionary, all of those different sectors, energy is up over 30% year to date, and technology is down 16%. So there's a 50% difference between one sector versus another. That's a really wide disparity. Makes it really challenging to pick winners and losers on individual stock picking, because that jockeying back and forth is happening so fast. So I think that the key is to not be overexposed to any one and overcommitted, because that volatility is really hitting the more granular you get within sectors.
Yeah.
I think even here too, I think this is, a good argument for, the stock returns have been so much of a growth story for so long, and value has really held value more this year. But I think it's that it goes back to, and as you said, you really need exposure across the board, because you don't know when those tides are going to turn. And sometimes a graph like this might have large caps in one place and small caps in a different place. But it doesn't matter if you're large or small. It's the growth and the value, and just once again how important it is to have all of those, all that variety.
Mm-hmm. Yeah. We have a question in the chat. I want to talk about this here for a second, about the current levels of inflation caused by supply chain issues. I want to talk about this in an equity perspective here too. The Fed, the question is, if the Fed is addressing a fast-growing economy and trying to slow it down by raising rates, shouldn't they be addressing things like supply chain issues and labor shortages that are causing pinches in prices, and it's all flowing through to the consumer? The Fed always has a challenge in that it can only pull on a string so much. Sometimes it's pushing on a string. That's why Janet Yellen famously said that inflation was an enigma when they were trying to get it from 1% up to 2% for many, many years, is that the Fed can only do so much. And raising rates to kind of cool the economy down in certain areas is one of those tools. I think one of the heartening things, if we're equity investors, is that all of these stocks that make up, these indexes are all made up of hundreds and thousands of companies that are all trying to navigate the same environment and earn a profit margin, whether inflation's high or low, whether the supply chains are clogged or whether they're open. And I think what we're counting on as investors is for the Fed to use their tools as effectively as possible and navigate a soft landing if they can. And also for the companies that make up these indices to navigate supply chain issues, to navigate the consumer demand and all those things, and to make that work. We're starting to see indications of that kind of breaking loose a little bit, of that becoming unclogged. So both of those things need to happen simultaneously. And frankly, that's what makes a market, is the uncertainty and confidence that goes back and forth with those two things happening at the same time.
Yeah.
All right. Cody, while we whip through it, we're going to touch on international, but can we get through, we want to talk about that, let's touch on international returns and then kind of the yield curve too.
Yeah. So not to skip over international, but knowing that we only have 30 minutes here, we want to try to skip forward for some of the trends we're seeing going forward too. But international has also been hit year to date too. Obviously, we all know what's going on in Eastern Europe, and it's potentially had an effect on some of the supply chain issues that Dennis was just talking about. But international has been hit year to date. Emerging markets is off a little more, just because normally emerging markets does have a growth tilt to it compared to some of the more potentially value play developed markets of international. But that has also been hit year to date too.
Mm-hmm.
So then skipping forward to some of the trends that we've been seeing, Dennis, do you want to do a brief description on what an inverted yield curve is?
Sure. Now, there's been a lot of talk of whether a recession is coming. I see that there's a print this morning that the economy contracted 1.4% so far this year. So are there indicators that would tell us that a recession is coming? The first, full disclosure, a recession is coming. We did not outlaw them. There's at some point in the future, there will be a recession, whether it happens 12 months from now, 24 months from now. That's a critical factor that no one really knows. But sometimes there are indicators that will be pulled forward to say, this might be something. One of them is an inverted yield curve. What that means is normally you get paid less for short-term income instruments like treasuries and more for long-term. So that slope is normal. Sometimes though, it inverts and you get compensated a higher rate for short-term investments than long-term investments. And that tends to be sometimes a bearish signal. What this chart shows you is, 6-month time periods going back 40 years and the stock market performance. To the right side here are when the yield curve is normal and you see a lot of positive returns and some negative returns when you have a normal yield curve. When you get an inverted yield curve, where on the left-hand side, same thing. You get some positive returns, some negative returns. So it's not cut and dry that when you get some of these indicators that pop up, that 6 months from now, 12 months from now, you're guaranteed to have a negative return in the stock market. There are plenty of instances in the data where that is not the case. Just wanted to kind of be cognizant with a grain of salt that those conditions they're not predictors full-time accurately.
Right. We never know that timetable or what's going to happen before that recession actually occurs.
Yeah.
That's the challenging thing. You can't make that specific bet. I also think when it comes to inverted yield curves, when there's a higher rate on the lower end and a lower rate on the longer end, a lot of that kind of goes back to sentiment and the investors' feeling of confidence in making that money in the long run. So yes, I love this graph here. Cody, if you want to give us a rundown of what we're looking at.
Yeah, so this is the consumer sentiment index and how they're feeling about their personal finances and how they're feeling about the economy going forward. On the high end means when they're feeling most positive, and on the low end is when they're feeling most negative or down regarding their personal finances and the economy. If we look at the numbers that we see on the down end, it is showing what the average S&P 500's, the US stock market return was over the next 12 months. So right now we're at one of the very low bottoms of how people are feeling about the economy going forward. But if we look back at some of the numbers where we've been this low before, in August of 2011, the next 12 months, the S&P returned 15%. In November of 2008, the next 12 months, the S&P returned over 20%. 2005 returned over 14%, and so on as you go through this chart dating over 50 years. If we look at the top end, when people are feeling best about the economy, and normally when they want to buy more stocks, you can see that the average next 12 months return of the S&P 500 is actually on the low end, which kind of goes back to just how people are feeling now. A lot of people are feeling skittish about the stock market, and they were feeling great back in 2021, where now you can make the argument that it would be the time to, if you can handle the volatility, get a little more aggressive in your investments.
And this is the paradox of investing. And I went back and I found a screenshot that I took in the spring of 2020. And Katie, you and I, we were all taking these pictures because there was a picture from Jim Cramer's show on CNBC where the background on his screen, the static headline was Dow has best week ever. And the headline on the bottom of the screen says, economy loses most jobs in history. And those two things were happening simultaneously. And we have to come to expect that a little bit. To the question about how a contraction in the economy impacts our investment strategy, a lot of this volatility is pricing in some contraction of the economy, that there was going to be some decline from these all-time highs of a growing economy. That's the Fed's intent. And it doesn't change our investment strategy, except sometimes to think of what does it mean that we have higher rates to earn on fixed income? What does it mean to have lower valuations on equities? Those types of things. But that's what the market prices in. And at some point, it's going to price in the recovery too. And that's when things bounce, even while the news is still probably feeling pretty awful.
Yep. Yep. And then this chart is always good to bring up. It goes over the intra-year. So every year, what the most decline was from the highs. As we go back over the last 50 years, the average intra-year drop at one point was over 14%. This year to date, this again is at the end of March, so we're actually down closer to 10% now. But you can see every year there's been an intra-year drop, but the average returns were still positive, over 75% at the end of the year. So 75% of the years were positive, even though we had a drop of an average of 14% at one point during the year.
Yeah, that's the heartening part about this. It's like, okay, if the S&P 500 is down 12%, what is that? Normal. You know,
Yep.
And we're coming off of 3 pretty strong years for equity returns. So a bad quarter on the heels of 3 really, actually a decade of pretty strong years is kind of to be expected.
So then the next, sorry, go ahead, Katie.
No, that's okay. I was just going to say, you know, I think it's also, as you said, a lot of this stuff is baked into the markets already. And when we think about projecting out over long periods of time, and when other, you know, financial institutions and so forth think about baking in where are we at now, where are we headed, it's important to recognize if we're looking out over 10 years or so, we're probably not going to have the same returns that we had the last 10 years, but we're likely going to be positive. We're likely going to have strong returns, at least to a degree. But there are areas that are probably going to be a little bit subdued. And we are going to expect there will be a recession. There could be multiple recessions. That's just kind of the nature of the cycles in the market. And it's never comfortable going through it, but to keep that long-term perspective of when I look up in 10 years, I'll make money. And I have a lot of confidence in knowing that our clients, if they're well diversified, they will make money over a 10-year period. But it never feels great during times of turbulence. Right.
And I think the other thing that we didn't include here, that's kind of the undercurrent, is that there are so many stocks, like take Peloton, for example. There are stocks that were high flyers during the pandemic. The narrative made sense, people staying at home, people working out. It's off 80% plus from its highs last year. So it's this natural wringing out of the risk and some unjustified stock prices that got really high during the pandemic. That wringing out has ripple effects that we all feel, but that's why we don't get overexposed to those sectors that can just be meteoric in their returns. So Cody, this is a different variation on the slide that we've used before. Tell us why this particular Callan chart, that periodic table chart that we use, why this one's different.
Yeah, so this one goes over the returns for the last 10 years. And one of the reasons we thought this was important to bring up was the black is the inflation number every single year. And knowing year to date, it's higher. And in 2021, it was higher than what the average was. But if you look over the last 10 years, the only asset that underperformed inflation every single year was cash. We will have volatility in the stock market and even sometimes in fixed income, as we've seen over the first quarter of this year. But over the time frame, the way to beat inflation is to stay invested, as one of the only assets underperforming it every single year was cash.
Mm-hmm. So yeah. if you've been a diversified investor over the last 10 years to any extent, you've made money on the upside in the stock market and kept up with inflation. In the moment, it doesn't feel good that you get a pullback like this, but it will recover. In the future, looking forward, your fixed income, it's lagged behind a little bit, but in the future, you're going to be able to earn higher rates on the conservative side of your portfolio. So I think there should be some reassurance looking backwards for anyone who's been diversified, and some reassurance looking forward. That doesn't mean now doesn't feel any better, but there should be some reassurance in how you can navigate what is to come. All right. Well, we're coming up on our time here. We have a couple of questions here. U.S. dollar being a reserve currency, and if so, what impact will it have on U.S. markets, bonds, everything else? I think there's just a lot of question about what would replace it. I mean, whether we have China replacing. I mean, China has its own turmoil right now. I think there's still a pandemic situation. There's still an economic and a geopolitical situation in China. So I think when we get geopolitics involved, it only reaffirms the value of the dollar as a reserve currency, which is helpful. But I really don't think we know to project that out too far. One interesting thing is when it comes to things like cryptocurrency, it's very interesting to watch what the function of those currencies are. They're not behaving like currencies. They're not behaving like inflation hedges either. So I think right now, it just reaffirms the value of the store of value of the US dollar as a reserve currency. So Katie, Cody, any just kind of final thoughts on what's happened in the first quarter and how you're thinking about planning and investing heading toward the end of this year?
Yeah, as I said, and we spend a lot of time researching, speaking with other people in the industry, kind of picking brains for what are you hearing, what are you thinking. We want to gain as much knowledge as we can when we think about assumptions that we use in planning, when we think about how we're designing portfolios, et cetera. And I go back to, we don't have to get everything perfect. We just need to make sure that we're avoiding the big mistakes. And once again, if we're looking at a longer time horizon, money will be made down the road. What we have going on right now, it's always different, but at the same time, it's normal and it's to be expected that we will have these periods of turbulence. And they're good from the perspective of, like you said, this is coming out of this, we're going to have higher interest rates. Coming out of this, this provides opportunities, once again, for tax loss selling, for rebalancing, for doing that gut check of where are you at from a risk perspective, and is it the right spot? It's always good to revisit your plan, but our planning assumptions really aren't changing that much going forward. We're still, once again, we're still in the camp of look up in 10 years and money will be made. And as long as we don't get greedy and try to dive in too far, I think most people are probably okay if they have a working plan.
Yeah. I think the more we talk about, is there going to be a recession? What are things that predict in the future? We found it to be much more effective to plan around the lifetime of a person, the lifeline, the events and circumstances that happen in an individual's financial life than the external circumstances. Similar to a company, how it navigates an economy, you're going to navigate these financial circumstances. That's why we're here. We appreciate all of you being here this morning and weighing in on the conversation. If we can be a resource for you, or if you have questions offline, feel free to contact any member of our team. We're going to continue doing these, and we want to make sure that we're providing some perspective as needed. So we'll wrap up here. Thanks all for joining us. Katie, Cody, great job this morning. Thank you. And we look forward to seeing and talking with all of you very soon.
See ya.
Take care.